Hello, hi guys. This is cabalakrishna from Lecturepedia.in. How are you? Hope you people are doing well. Even I am fantastic. In the today's class, we will be revising audit of banks. Now, if you see the weightage of this chapter is around 4 marks, you can say, okay, 3 to 4 marks, along with NBFC and this chapter, you will get around 6 to 7 marks like that. You will get okay. Now, the length of this chapter is a little bit huge, you can say, but it is quite easily understandable. Now let us start the revision of audit of banks. Now first of all, the banks, they are having certain special characteristics, right? Because of these special characteristics of banks, in the audit of bank there need to be special audit considerations that needs to be taken into account. Now what are these special characteristics of banks? First of all, nature of risk associated with the banks. Because banks deal with cash, obviously the risk will be high. Next, scale of operations. If you see, each bank will be having a number of branches, thousands of branches it will be having. So the scale of operation at which the banks operate will be very huge. And extensive IT dependence, obviously in case of a banking company, you cannot visualize today's this present era's banks without information technology. And statutory and legal requirements, there are various laws and regulations that are applicable on the banks. We will be seeing in the next concept what are the laws that are applicable for the bank. And continuing development of new products and services. Each and every month there will be new products coming in the bank. Okay, there will be credit cards, there will be ATM, there will be agricultural loans, there will be educational loans, there will be FDs of different interest rates. Like this, the different types of products will be launched by the bank each and every month. So all these characteristics makes the auditor to have certain special audit considerations in case of a bank. Now, as I have already told you, there are various laws and regulations that are applicable to the bank, like Banking Regulation Act, RBI Act, Companies Act, RRB Act. RRB means Regional Rural Bank. Information Technology Act, PMLA, Prevention of Money Laundering Act, SURFACE, that is Securitization and Asset Reconstruction Act. Next, Payments and Settlement System Act, Cooperative Society Act, SEBI regulations. Okay, in case the bank is a listed entity, then SEBI LODR regulations are also applicable to the bank. So these are just some examples. Still, there are various laws that are applicable on the banks. Next, financial statements. Just like for preparation of financial statements of a company, Schedule 3 of a Companies Act is having a format. Even here for financial statements of bank, Schedule 3 of Banking Regulation Act has given a format. Form A consists of balance sheet format. Form B consists of profit and loss statement format. So you have to prepare these financial statements of bank as per this format only. And disclosure requirement under Section 133 of the Companies Act. Section 133 deals with accounting standards and Indian accounting standards. So the banks then need to comply with Indian accounting standards or accounting standards as per their applicability requirement. Okay, they should comply with Ind AS. Next, appointment of auditor. How the appointment of auditor will be done in case of a bank? If the bank is a nationalized bank, board of directors will make the appointment. If in case of other banks, AGM, the members will make the appointment. However, in both the cases, RBI approval is mandatory. And in case of SBI, there was a different procedure earlier. But since SBI is also a nationalized bank, you please strike off this and include SBI also in the nationalized bank itself, RRB in other banks. Okay, you please strike this off. Hope that is clear. Next, stages of bank audit. If you see, there are 5 stages in the bank audit. Before planning, there is a initial consideration stage. So in initial considerations, what will you consider? Acceptance of audit, whether to accept the audit or not. Declaration of indebtedness. If you are having any loan with that bank, if you are having loan with that bank, you should not conduct the audit of that bank. Next, internal assignments, whether you have taken up any internal assignments. Terms of engagement, communication with the previous auditor, planning, engagement team. So all these will come under initial consideration. After that, you will understand the bank and its IT environment. Just like as per SA 315, you will identify and assess risk of material misstatement through understanding the entity and its environment, right? So here you are understanding. In next stage, you will assess the risk. You will also understand internal controls, accounting process that the bank is following, and risk management process. All this you will understand, and based on that understanding, you will assess the risk, identifying and assessing risk of material misstatement, risk of fraud, including money laundering. See, in case of banks, the fraud of money laundering, the risk of money laundering is very high. Money laundering means converting black money into white money. Banks play a crucial role in this process, so you should assess the risk of fraud with respect to money laundering. Next, assess a specific risk associated with outsourcing activities. Banks will outsource various activities, right? Here SA 402 will be applicable. Next, execution stage. Based on the risk engagement team discussion, you will discuss with the engagement team response to assess risk. How you will respond to assess risk? By designing respective audit procedures, right? Determine audit materiality, consider going concern of the bank. And finally, based on your execution, you will find out certain points. Those you will report. In reporting stage, you will give audit report, you will give LFIR. Okay, in case of bank, apart from audit report, there is also other audit report known as a long form audit report or LFIR. That also you need to give. And also, if at all any other certification is required that is specific to the bank branch, then report on any other matters. Okay, these are the 5 stages of bank audit. Next, internal controls in certain selected areas. Now, in case of bank, internal controls are very much necessary. We will see some of the internal controls in certain areas. First of all, we will see general internal controls that has to be there. See, general internal control. Shift staff positions without prior notice. Okay, you have to shift the position of the staff without giving prior intimation to them. Okay, you should not allow the same person to be in the position of cashier. You should not allow the same person to be manager of the same branch for a long time. Okay, you need to shift their positions. Next, maker checker concept should be there. Next, prove arithmetical accuracy of books of accounts every day, right? Every day bank staff should leave the bank only after tallying their books of accounts. All bank forms in possession of one officer, mail should be opened only by the responsible officer only. Okay, you should open only your mail. Only the authorized person has to open the mail. Next, clear differentiation of financial powers should be there. Okay, who can grant loan up to certain value, and if that value exceeds, whose permission is required, and who can uh, you know make entries in the books of accounts. So all those financial powers should be clearly differentiated. Next, periodic surprise inspection of head office and branch offices should be conducted. Okay, these are certain general internal controls that has to be implemented in case of a bank. Now, with respect to cash, what are the internal controls that has to be there? First of all, cash should be in the joint custody of 2 officers. Okay, you should not give the responsibility of cash only for one officer. Okay, if you have seen the movie, the recent movie that has come with respect to of Dulkar Salman, Lucky Bhaskar. If you see in that Lucky Bhaskar movie, the cash, it is held with the responsibility of 2 officers, right? Next, daily test check and occasionally fully count the cash by some other higher officer other than the cashier. Okay, the cashier, he will daily test check the cash, and other officer will also test check the cash, but occasionally the higher officer like manager or senior cashier, he needs to detailedly check the cash, he needs to tally the cash. Next, no access to cashier to customer account and the day book. Okay, cashier should not be given access to the customer account and the day book, because there is a possibility that he might take away the cash and pass the fake entries to adjust that in the customer's account. Make payment only after authorization and entry in the customer account. Okay, if at all any customer comes from for withdrawal, you have to make entry in the customer account only after you have to make payment to that particular customer only after entry is made in the customer account. Next, compare receipt payment scrolls with cash column of the day book. High volume cash transactions to be verified by higher officer or manager. Okay, there will be certain limit of volume of cash that will be specific to each bank. If any transaction is exceeding that particular value, then that cash transaction has to be specifically verified by the manager or some higher officer. Next, remit excess cash to currency chest according to the bank's retention limit. See, each branch based on its advance size, there will be a retention limit for the cash. That means let's say for example a branch can have only 15 lakhs cash with it. Now at the end of the day, if the cash balance with it is exceeding 15 lakhs, that excess cash balance it has to be sent to the currency chest. Okay. Next, check truncation system. What is this check truncation system? Check truncation means you will tear off the check once it is cleared. That is known as check truncation system. Now, certain internal controls with respect to this check clearing. Call or email the customer if check received for 5 lakh and above, auditor shall test check. Now, if any check is received for clearing and the value of the check is more than 5 lakh, once the bank uh, officials, they have to call the customer and ask the customer, a check has been issued by you for more than 5 lakh. We have received the check for clearance. Whether this check has actually been issued by you, like this you need to test check with the customer. This is one of the internal control. Next, check whether signature of drawer of the check is being verified by the bank staff. Okay, in the on the check there will be signature, and bank will be having a specimen signature of the customers. So in the system they will be having a specimen signature. Okay, in the CBS core bank system they will be having that. So before clearing the check, they have to check whether the signatures are matching or not, and in case of unpaid checks, they have to be given back to the customer. Okay. Next, bills for collection. Now, in case the bank has received any bills from the customer for the purpose of collection, then the internal controls that has to be there are all relevant documents to be received and entered in the register. Okay, whatever the documents that you have received with respect to bills collection, all those documents has to be entered into the register, and credit the customer account only of the bill have been collected. Okay, you need to credit the customer's account only if this bill has been collected by the bank. Okay, the amount that is mentioned in the bill has been collected from the respective person, only then you will credit the customer account. Next, ensure that there is no dual entry for bills sent from one branch to other branch. See, sometimes what happen is branch of Hyderabad might send the bill for collection to branch of Mumbai, because the respective person who will give the amount is present in Mumbai. Now, in this situation, what will happen is the entry for bills for collection is made in the Hyderabad branch and also in the Mumbai branch. Now, at the time of consolidation, while preparing the financial statements, you should ensure that only one entry with respect to this bill is shown in the financial statements. Okay, remaining entry should be cancelled off in the amalgamated balance sheet. Okay. Next, bills purchased. Now, in case bank has purchased the bill, then officer has to verify that title documents are assigned to the bank. Okay, if you have purchased the bill, ownership of the bill has to be transferred to you. Next, sufficient margin or discount should be kept. Okay, if the bill amount is 1 lakh rupees, you should not purchase it for 1 lakh rupee. You should keep a margin of 5% or 10%. Like for 90,000 you should purchase it, or for 95,000 you should purchase it. That remaining 5,000 or 10,000 is your profit. Next, if bank fails to collect on due date, take steps to recover from the drawer. Report irregular outstanding accounts to the head office. For bills outstanding at close of the year, properly apportion the discount between 2 years. Okay, let's say on 29th March you have purchased the bill, and this bill is due to be collected in April or May. Now, in this situation, the commission amount that you earn on this bill has to be apportioned between 2 years, right? Till March it will be one financial year, after March it will be another financial year. So that apportionment of commission has been made properly or not, that internal control should also be there. Next, loans and advances. Internal controls with respect to loans and advances. See, whenever you are granting any loan to the borrower, you have to properly check credit worthiness of the borrower, and also you would have observed while taking the loan there will be this much bunch of documents that you have to sign. So the internal control is execute all necessary documents, and you should also maintain sufficient margin with respect to the security. Let's say you are giving you will not give the loan without any security. Let's say you have accepted a land for the security, and the market value or the value of that land is some 10 lakh rupees. Now in this situation, for this land you should not give entire 10 lakh loan. Okay, you will only give some 70% or 80%, like 7 lakh or 8 lakh as loan. The remaining is the margin for you. If who knows, suddenly in future if the value of that land decreases, then the borrower, he will not repay the amount, right? So sufficient margin has to be kept. Next, securities in joint custody of two officers. Just like the cash is kept in the joint custody of two officers, even the securities has to be kept in the joint custody of two officers. Register securities in bank's name. Okay, and all accounts to be within drawing power and sanction limit. Temporary limit of 20% can be granted for maximum 90 days. Okay, all the accounts, they should be within drawing power and sanctioned limit. Sanctioned limit means the actual limit that has been sanctioned. It can be, let's say for example, 10 lakh. Now 10 lakh sanctioned means you cannot withdraw entire 10 lakh. You can withdraw only up to your drawing power. Now drawing power will be calculated every month or once in every 3 months based on the practice of the bank. This, for calculating drawing power, generally it will be calculated based on book dates, based on stock available with the customer. Now for calculating that, the customer will have to give on a monthly basis or on a quarterly basis a stock statement. Based on that stock statement, you will calculate the drawing power. Let's say the stocks available with the customer, or let's say 10 lakh worth of stock is available. Now of these 10 lakh worth of stock, you will reduce creditors. Let's say creditors are 2 lakhs, you will reduce 2 lakh, 8 lakhs. Now of these 8 lakhs, you will take up margin of 25%. If you take margin of 25% from 8 lakh, roughly it will be around 6 lakhs, right? So 6 lakhs your drawing power. Even though sanction limit is 10 lakh, your drawing power is only 6 lakh, because it will be calculated based on the stock that is available with you. So however, a temporary drawing power of 20% excess can be given for a temporary period of maximum 90 days. Okay, you have arrived at drawing power of 6 lakhs. On these 6 lakhs, some additional 20% extra drawing power can be given for a maximum up to 90 days. Okay, hope that is clear. Next, irregular accounts to be brought to the notice of head office and review operation in each advance account at least once in a year. Okay, once in every year you have to review whether the loan is being repaid properly or not, and what transactions are being occurred in this loan account. Okay, next, coming to credit card operations. So what are certain internal controls that has to be there with respect to credit card operations? So first of all, while granting any credit card to the customer, you have to effectively screen his application. Okay, effective application screening with good credit assessment. Next, control over storage and issue of the credit cards. Next, merchant confirms unutilized limit of card before accepting. Now merchant at his point of sale, while accepting the swipe of the credit card and deducting the amount, a confirmation request will be sent to the bank to check whether this customer is having that respective credit limit or not, right? That has to be confirmed by the merchant for each and every transaction. That is also one of the internal control. Next, prompt reporting by merchant of all settlements accepted through cards. Okay, of whatever the amounts that the merchant has accepted through card, that has to be promptly reported to the respective bank. However, all this, it will be handled by payment gateways nowadays. Okay, they will take care of all these controls. Next, reimburse to merchants only after verification of merchant card acceptance. Okay, you will reimburse the amount to the merchant only after verifying whether merchant has actually accepted the card or not. Next, immediately charge to the customer. After you reimburse to the merchant, you will charge the same amount to the customer, because you have to collect from the customer the same amount at the end of the month, right? Next, send regular statements to the customer. Credit card statement has to be sent to the customer on a regular basis so as to collect the amount from the customer. Next, review accounts periodically to revise the limits. You have to review the account of the customer periodically and revise his limits. Monitor and follow up customer payments. Okay, you need to monitor and follow up whether customer is regularly paying the credit card bill or not. Okay, next, CRR SLR. CRR means cash reserve ratio. As of now, the CRR is 4.5%. SLR means statutory liquidity ratio. As of now, the SLR is 18%. Now CRR means the bank has to maintain this much amount of cash or deposit with the bank. With the bank means RBI. So of the total advances that of the total deposits, demand and time liabilities, we call it as, okay, DTL. Of the total demand and time liabilities, it is having 4.5% has to be maintained as CRR in the form of cash with itself and cash deposited with RBI. Next, of this demand and time liabilities, 18% has to be kept as liquid assets in the form of cash, gold, and some government bonds or deposit with RBI. Hope that is clear. And this SLR will be verified by the auditor at 12 odd dates of physical year, not being Friday. Okay, the auditor, he will select 12 odd dates, okay, one day in each month, not being a Friday, and he will verify whether SLR requirement of 18% has been maintained or not. Now, for maintaining this SLR and CRR, demand and time liabilities has to be calculated, right? These demand and time liabilities will be calculated on last Friday of preceding fortnight. On last Friday of preceding fortnight, how much demand and time liability is there? On that demand and time liability, this CRR and SLR will be maintained. Now, for calculating this demand and time liability, there is a certain procedure. Okay, you need to include certain items, you need to exclude certain items. Let us see. Audit approach regarding CRR and SLR. Understand RBI circulars regarding demand and time liability. Examine demand and time liability position based on consolidation of branch trial balances. Exclusion in DTL. Now, while calculating DTL, you need to exclude following. What are they? Paid up share capital, reserves, loan from RBI, loan from Exim Bank, loan from National Housing Board, loan from SIBI, loan from NABARD. Okay, if you have taken any loans from these people, you need to exclude it from calculation of demand and time liabilities. They need not be considered as demand and time liabilities. Next, amount of recovery is from doubt and bad debts. Amount of part recoveries, you can say, okay, once you have considered any debt as doubtful debt, and if you have recovered any amount from that bad and doubtful debts, you should not consider it in calculation of demand and time liabilities. Next, amount received in INR against import bills held in sundry deposits pending receipt of final rates. Now, let's say, for example, an importer has imported some goods into India. Now he needs to make the payment to the exporter in foreign currency, but he is not having foreign currency. What he will do? He will deposit Indian currency with the Indian bank, and Indian bank will convert it into foreign currency and it will pay to the exporter. Now the customer, Indian customer, importer, has deposited the amount with the Indian bank, but Indian bank is still waiting for converting that Indian currency to foreign currency, because still the rate of exchange is not received. So in that time duration, that amount will be lied with the bank itself, and that is a liability for the bank. Even though it is a liability for the bank, it should not include it in the demand and time liability calculation. Next, unadjusted balances in link branches for payment made by such bank. That means for payment of dividends, for payment of consideration with respect to buyback of shares, what the companies will do is they will deposit the amount with the particular bank, and they will ask the bank to make the payment to the shareholders. Now the bank, what it will do is it will make the payment through its branches. Now if at all the amount is still lying with the bank and not yet paid to the shareholders, that will be liability to the bank, and such amount should not be included in the demand and time liabilities, even though it is a liability. Okay, next, margins held and kept in sundry deposits for funded facilities. Funded facilities means, the example of funded facility, you have given a guarantee. Now you will not give guarantee just like that. You will ask for a deposit, and based on the deposit you will give guarantee. Okay, if the customer gives a deposit of 1 lakh rupees, now you will give a guarantee of 1 lakh rupees. Okay, so this is a funded facility wherein you are providing a guarantee based on the fund that has been given. Now this fund that is available with you, it is a liability to you. Even though it is a liability, you should not include it in demand and time liabilities. Okay, next, inclusions in demand and time liabilities. What points you need to include in demand and time liabilities? Net credit balance in branch adjustment account. See, generally branch adjustment accounts should be tallied at the end of the year. Okay, you should not keep any amount in the branch adjustment account. So to encourage the banks to adjust the entries between the branches as quickly as possible, what the RBI told is, if at all there is any credit balance in the branch adjustment account, that will be considered in demand and time liabilities. Now what will happen if you consider it in demand and time liabilities? If you consider it in demand and time liabilities, the value of demand and time liabilities will increase. If value of demand and time liability increases, the CRR ratio and SLR amount will increase, because you will apply 4.5%, 18% on DTL only. If DTL amount is huge, the amount of cash that should be kept with the bank will be huge. Now if more amount is blocked in the form of CRR and SLR, the amount that is available to the bank for giving loans will be less. If it gives less loans, then the profit it makes will be less. So that much impact it will have. So in order to encourage the banks to clear these branch adjustment accounts as early as possible, if at all, the RBI told that if at all there is any credit balance in the branch adjustment account, that will be included in calculation of DTL. Next, borrowings from banks abroad. Okay, if at all you have taken any borrowing from abroad bank, then that will be included in calculation of demand and time liability. Next, interest accrued but not accounted in books of accounts. Okay, if at all there is any interest that has been accrued but that is not yet due, even such type of interest will be included in demand and time liabilities. Okay, next, verification of certain assets, starting with a cash balance. How will you verify cash balance? Obviously you will physically verify the cash. So physical verification at ATM and physical verification of cash that is available with the bank, and physical cash to be agreed with the balance that is available in the cash register or CBS means core banking system. So the balance of cash that is being shown in the books of account should match with the actual cash balance that is available with the bank. Okay, next, balance with RBI. Now the banks, they will also maintain certain balance with RBI. How to verify that balance? Verify balance confirmation certificate and reconciliation statements. Okay, you should ask for a balance confirmation certificate from RBI and review reconciliation statements with special attention towards the following: cash transactions remaining unresponded, revenue items requiring adjustments, other credit and debit entries remaining unresponded for more than 15 days. Next, bank balances, balance with other banks. Now banks, they will also maintain balances with other banks, like SBI, it might have some balance with HDFC, various other banks. So that interbank transactions will happen, because the customers of one bank will transfer the amount to other bank. There will be checks issued from one bank to other bank by the customer. So obviously the amount of one bank will lie with other bank in its normal course of business, right? So how to verify that? Same procedures as you have followed in the above for RBI balance. Apart from those procedures, you should also following these procedures. No debit for charges or credit for interest is outstanding. Okay, there should be no transactions outstanding simply. No check sent or received is in clearing is outstanding. Examine large transactions to ensure there is no window dressing. Window dressing means passing fake entries to hide the frauds. Check bills or checks outstanding as on date or created subsequently. Okay, next, money at call and short notice. Money at call and short notice means loan that has been given for a short period of time, very short period of time, like for 1 week, 5 days, 2 days, 1 day. Okay, such type of loans are known as money at call and short notice. Generally for these types of loans there will not be any security, and these type of loans will be given only for the people who are having a high credit worthiness and who are very much familiar to the bank, and mostly these loans will be given between the banks. Okay, from one bank to another bank. See, for these money at call and short notice, there should be proper authorization, compliance with instructions of head office and the controlling office, verify with certificate of borrower and call loans receipts held by the bank. Okay, you should, the auditor, he should ask for a certificate of confirmation from the person who has taken the money at short notice. Next, examine subsequent repayments received. Do not net off call loans given against call loans taken. This is important. Now, SBI Bank, it has given a call loan to HDFC Bank. At the same time, SBI Bank has also taken a call loan from ICI Bank. Now, this bank, it should present them separately. It should not net off call loans taken and call loans given. Okay, next, verify accounting of the interest. Okay, the accounting for the interest has to be made accurately. You need to verify that. Next, audit procedures for investment. Now here investments, they will be of two types. Bank, it will invest its own money, it will also invest its clients money. Okay, banks can provide portfolio management services, because there will be various general public who don't understand stock markets, who don't understand where to keep their money. So those type of people will take the help of the bank because bank will have certain expert people who will invest the money of the customers. So bank will provide portfolio management services. So here, with respect to audit procedure for investment, you need to first of all review investment policy for the bank. Each and every bank will be having its own investment policy. In the investment policy, the objective of its investment will be there, and where should the what are the permitted investments for the bank. All this will be listed down in the investment policy. Next, separation of investment functions. Okay, all the investment function should not be handled only by one person. Okay, there should be separation for investment function. Next, physically verify investment scripts. Okay, you need to verify the physical documents of investments. If at all physically the documents, investment certificates, they are not there, you should ask for a statement from depository. Okay, if at all the investments are in demat form. Next, obtain confirmation from the depositors and custodians. Examine proper classification into HTM. HTM means held to maturity. Next, HFT means held for trade. AFS means available for sale. So bank has to classify its investment into these three categories, and based on the change of its decision, it will shift its investments from one category to another category. So auditor needs to verify this. Next, examine valuation accounting of income from investments and special purpose certificate related to investment. The auditor, he needs to give a special purpose certificate with respect to investment. In that, while giving that certificate, the auditor needs to examine the following. See, examine whether separate accounts are maintained for investment on their own, investment on PMS client's account, and other constituents. I have told you now, investments will be made on their own and also on behalf of clients as part of portfolio management services. So accounts for these two has to be maintained separately. Next, get investment under PMS separately audited by the external auditor. Okay. Next, advances. With respect to advances given, what are the audit procedures that you will perform? Correctness of master data. Master data means what will be included in the master data: name of the customer, address of the customer, contact details of the customer, rate of interest of the customer, what is the amount of loan given to the customer. Okay, all these will be there in the master data of the customer. Next, all accounts of the customer are tagged to single customer ID. See, a particular customer, he might be having savings account with the bank, loan account with the bank, FD account with the bank. Okay, like this, he will be having various accounts with the bank. Now, for each account, there will be a separate account number, but all these accounts should be tagged to the single customer ID. Okay, each customer will have only one ID. Whatever the accounts he opens, those accounts will be tagged to that single customer ID only. Okay. Next, examine problem accounts not yet slipped into NPA. Okay, problem accounts, they will be categorized into SMA 0, SMA 1 and SMA 2. Basically, those accounts that have turned into NPA and in the stage of NPA, sorry, not in the stage of NPA, before NPA, if the amount is overdue for 0 days to 30 days, you will classify it as SMA 0. For 31 days to 60 days, you will classify it as SMA 1. For 61 days to 90 days, you will classify it as SMA 2. And above 90 days, then it will slip to NPA. Okay, so before NPA itself, to properly monitor and recover the amount from the customer, these three categories have been kept. Okay, they will be known as serious mention accounts, SMA. Next, examine accounts adversely commented by the current concurrent auditor, internal auditor, or RBI inspection team. Okay, the statutory auditor, he needs to go through the reports of concurrent auditor, report of internal auditor, report of RBI inspection team. Now, in their reports, if they have adversely commented on any accounts, the auditor, he needs to specifically verify those accounts. Okay, and you should examine restructured accounts. See, restructured accounts means if at all borrower has negotiated for increase in the tenure of the loan or certain reduction in the EMI, so these types of adjustments to the loans is known as the restructuring of loans. If at all there is any restructured loans, you need to examine it very carefully. Next, examine quick or early mortality accounts. What is quick or early mortality accounts? Within 12 months of granting the loan, if that loan becomes NPA, such a loan is known as a quick or early mortality account. Next, completeness and accuracy of interest being charged. You should verify completeness and accuracy of the interest that is being charged on the advances. If at all there is a slight change in the rate of interest that is being given in the master data, that will affect a lot of interest amount lost to the bank, right? So you should verify completeness and accuracy of the interest that is being charged. Next, recoverability of advances. How should you review whether the the amount can be recovered or not? Periodic statements submitted by the borrowers. We have to verify the periodic statements that the borrower submits in case of working capital loan, right? Next, latest financial statements of the borrower you need to see. Reports on security inspection you need to verify. Review audit reports of borrowers whose credit facilities are beyond cut-off limits set by the board of directors by the bank. Next, classification and provisioning. You need to properly classify your advances into standard, substandard, doubtful and loss, and based on that you should also provide respective provision, right? So whether classification through CBS without manual intervention, okay, whether the core banking system software is having the ability to automatically classify the account into standard, substandard, loss and doubtful without manual intervention, and whether classification is appropriate, okay, whether the CBS has done the classification appropriately, proper segregation into secured and unsecured, and the provisioning. Compare date of NPA mentioned in current year statement with previous year, reasons for a change. Okay, if at all this account is NPA during previous year, also you compare the date of NPA that is mentioned in previous year and in the current year. Next, regularization near balance sheet date. Regularization means an account has turned NPA. When will it be out of the state of NPA? If the amount is repaid, okay, if the outstanding amount is repaid, then it will be out of the state of NPA. So that process of bringing an account out of NPA is known as regularization. Now, if such regularization is done near to the date of balance sheet date, auditor should be very careful with respect to these type of accounts. See, need not be treated as NPA. Once the regularization has been done, you need not treat it as NPA. But however, such repayment of funds to the account is there, that funds should have come from genuine sources. It should not happen that sometimes what will happen is, in order to reduce the provision, banks, they will grant a fresh loan to the borrower, and borrower with that fresh loan, he will repay the amount of loan that has been classified as NPA. This is wrong. Okay, if that is happened, you should not consider, you should consider this account as NPA even if the regularization has been made, because regularization has been done, has to be done from the genuine sources. See, whether repayment is out of genuine sources or not, account indicates inherent weakness, then you need to deem it as NPA even though the account has been regularized. If there is an inherent weakness in the account, inherent weakness in the account means the borrower has filed for insolvency. Okay, the account is not NPA, but he has filed for insolvency. In this situation, there is an inherent weakness in the account. Borrower will not repay the amount, right? Filing for insolvency itself means that the meaning is that he is not having amount to repay all his loans, right? So in this situation, if there is inherent weakness, you should deem that account as NPA. Next, specific care in determining date of NPA. Next, drawing power calculation. About this drawing power calculation, I have already told you, right? As per guidelines formulated by board of directors by the bank, you need to follow the guidelines of board of directors. What happened? Just a second. Yeah. Ensure that stock doesn't cover amount outstanding to creditors, and stock under LC means letter of credit and guarantee. See, while calculating the stock, amount of creditors has to be reduced, and also stock that is under letter of credit or guarantee should also be reduced. This point I have already told you. Next, in case of construction business, mobilization advance has to be reduced and proper valuation of work in progress has to be done. Mobilization advance means while you start a project, if at all any person wanted to purchase the flats in your apartment, you will take certain token amount or advance, right, before starting the project itself or during the construction phase. You will accept certain advance. Such advance is known as mobilization advance. Okay. Next, Review stock audit reports. You need to review the stock audit reports that has been submitted. Note, these stock audit reports for calculation of drawing power should not be older than 3 months. That means for every 3 months, at least for every 3 months, the borrower has to submit the new stock statement, and based on that, the drawing power will be calculated. If stock statement is not given for every 3 months, you can consider that account as irregular. Okay, next. Limits not reviewed within 180 days from due date of ad hoc sanction, then consider the account as NPA. In case of ad hoc sanctions, if the limit is not reviewed within 180 days, okay, for a period of 180 days, you can consider that account as NPA. Next, classification to be borrower wise and not facility wise. See, if a particular borrower has taken two loans, one is long term loan, one is working capital loan. Now, working capital loan has turned into NPA, but long term loan is not NPA. Now, in this situation, even though the long term loan is not NPA, since the working capital loan has turned into NPA, you should also treat long term loan as NPA because this belongs to same borrower. Okay, so classification is borrower wise but not facility wise. Next, government guaranteed advances. Now, if for a particular advance government has given the guarantee, then with respect to such advance, the income, the interest income is there na, that has to be recognized only if it has actually been received. Okay, if the government guaranteed advance has become NPA, then with respect to NPA, interest income has to be recognized only if it has actually been received. Okay, even though the loan is not guaranteed by government, if it turns into NPA, with respect to NPA, income has to be recognized only if the amount is actually received. Okay, only if the interest amount is actually received. Next, classification of government guaranteed asset. If the loan is guaranteed by state government, then if that account turns into NPA, you can categorize it as NPA. Next, if the account is guaranteed by, loan is guaranteed by central government and that loan becomes NPA, in such a situation, you should not treat that loan as NPA until and unless the bank has invoked the guarantee and central government has repudiated such guarantee. Until and unless central government repudiates the guarantee, you should not treat the loans that have been guaranteed by central government as NPA. Okay. Next, coming to agricultural loans. Now, NPA norms in accordance with SLB committee in each state. Basically, in each and every state, there will be state level board committee. Okay. Now, there will be norms that will be prescribed by SLB. You should follow such norms. Now, as per generally in every state, the crops will be categorized into short duration crops, long duration crops. Short duration crops means they will be for less than or equal to 1 year. Okay, the cropping, okay, the yield, you will get the yield from the crop within less than 1 year. If the yield is got to you for more than 1 year, then such type of crops will be known as long duration crops. Now, NPA classification in case of agricultural loans is based on this short duration and long duration. In case of long duration crop, if the amount is overdue for more than one crop season, it will be treated as NPA. And in case of short duration crops, overdue for more than 2 crop seasons, it will be treated as NPA. And ensure these norms are made applicable to all agricultural loans that are listed in master circular. Now, RBI will issue a master circular. In such master circular, it will list down what will be treated as agricultural loans and what will be treated as non-agricultural loans. Only if that loan is falling under the list of agricultural loans as per that master circular, you need to apply this criteria. Okay. Next, restructured advance. Restructured advance, I have already told you what is meant by restructured advance. Now, with respect to restructuring, you need to ensure compliance with RBI circular. Standard, substandard, doubtful assets can be restructured. Okay, these 3 categories of loans can be restructured, and restructuring cannot be made with retrospective effect. Okay, you can make restructuring only from the prospective effect. Okay, let's say as part of restructuring, you are reducing the interest rate. Now, interest rate, it cannot be reduced from retrospective effect. It can be reduced only from prospective effect. So, whatever the restructuring that you do, it has to be done only from the prospective, not from the retrospective. Next, on restructuring, standard is downgraded to substandard. Okay, if a standard asset is restructured, then automatically that will get downgraded to substandard stage because it is restructured. However, if a NPA is restructured, it will remain in NPA stage only. Next, examine accounts upgraded during year, do not upgrade on part recoveries. Next, sale or purchase of NPS. With respect to sale or purchase of NPS, certain aspects has to be verified. First of all, examine policy laid by the board of directors. For sale and purchase of NPS, there will be a policy that will be laid by the board of directors. You need to verify that. Next, must have remained as the NPA for at least 2 years. See, you can sell only those NPAs which are in the state of NPA in your books of accounts for at least 2 years. Okay, next, without recourse basis you have to sell. Without recourse basis means once you sell, that's it. If in case the purchaser of that NPA is not able to recover the amount from the borrower, the bank, the seller should not have any further liability. Okay, selling without any further liability is known as selling without recourse basis. So whenever you sell NPS, it should be without recourse basis and only on cash basis. You should not sell NPS on credit basis, and do not purchase NPS which you have originally sold them earlier. Okay, you should not purchase a NPS which you have sold them earlier. The same NPS you should not purchase, and remove from the books of seller. Once you sell the NPS, you need to remove them from the books of accounts. Next, non-banking assets acquired in satisfaction of claims. That means bank has given a loan. For that loan, the borrower has kept land as security. Now borrower is not able to repay the loan amount. So what the bank will do? Bank will take over that land. Now this land is non-banking asset acquired in satisfaction of claims. Now with respect to this, ensure these are held with the intention of dispense of. Okay, bank should not held that with itself. It should dispose it of. Generally banks will conduct auctions. In those auctions these type of assets will be disposed of. Okay, verify documentary evidence, check ownership is vested with the bank, compliance with holding period of such assets. See, so those type of assets which you have acquired as part of satisfaction of claim, you can keep those assets with you for a period of up to 7 years, maximum 7 years. However, if you wanted to use that asset for your personal use, then you can keep it even for more than 7 years. Okay, if you are not intending to use it for the personal use of the bank, then it can be maximum kept with the bank for a period of 7 years, and you have to sell it off within that period. Next, lower of net book value or of advance or NRV of asset. Okay, at how much value you should recognize this asset? Lower of net book value of the loan amount or realizable value of the net realizable value of that asset. Okay, lesser of these two values you need to recognize the asset in your books of accounts. Next, capital risk adequacy ratio, you will call it as CRAR, CRAR. The minimum CRAR is 9%. How to calculate this CRAR? Eligible total capital funds divided by risk weighted assets and off balance sheet items multiplied by 100. Okay, basically if you see in case of NBFC, we have a list of risk weighted assets. Just like that, even for banks also there is a risk weighted asset that has been given, but that list is not there in the syllabus. Okay, but this process of calculation of CRAR we have seen even in case of NBFCs, right? Next, stress testing. What is this stress testing? In case of this stress testing, you will test whether bank will be able to withhold the economic shocks, unforeseen circumstances. Okay, whether bank is having that much amount of capital with which it can withhold the unforeseen circumstances in the economic situation. Okay, that will be tested in case of stress testing. Okay, test to understand whether bank has enough capital to survive adverse economic conditions. Next, current and savings account. Verify adherence to KYC norms. KYC means know your customer. Check interest calculation has been done properly or not. No transaction for 2 years, then that account will be treated as inoperative account. Okay, if at all there is no transaction in the account for a period of 2 years, then such account should be treated as inoperative account. Significant reduction in balance of revived inoperative accounts, check authorization for withdrawal. Okay, now an account has become inoperative, and in case such account has been revived and there is a significant reduction in the balance of the account that has been revived, then you should ensure that there is a proper authorization for withdrawal of amount from such a revived inoperative account. Okay, next, Basel III framework. What is this Basel III framework? Basel III framework, it is related to the stress testing. Basically, it will help to increase the ability of the bank to withhold this type of adverse economic conditions. Basel III framework, it will be having various requirements that needs to be complied by the bank. See, like the minimum capital that the bank has to maintain, the SLR requirement, CRR requirement, various ratios, all this will be part of this Basel III framework. This Basel III framework is international framework. Okay, now this will aim at improving banking sector's ability to absorb shocks from financial and economic stress, improve risk management and governance practices, strengthen banks' transparency and disclosure standards. Next, bills payable by the bank. See, with respect to bills payable, following internal controls has to be checked. Standard formats for drafts, mails, transfers and traveler checks should be there. Okay, for DDs, for traveler checks, all these become bills payable, right? So there should be standard format for these documents, and unused forms should be under the custody of a responsible officer. Okay, all the forms which are unused, they should be kept with the custody of the proper officer. Reliable private codes known only to the responsible officer, and signatures on demand draft to be checked with specimen signature book. This point we have already seen. And once a telegraphic transfer or DD is issued, immediately give advice to the concerned bank that in your name a DD or telegraphic transfer has been issued. On payment, paying bank shall send advice to the originating bank. Okay. Next, contingent liabilities. What are the various contingent liabilities that the bank can have? See, you should be very careful with respect to these contingent liabilities, because most of the times they will be off balance sheet items. They will not be entered into the books of accounts. But in case of a banks, to maintain record of these contingent liabilities, an entry has to be passed in the books of accounts, but they will not be reflected in the balance sheet or profit and loss statement, but they will be shown as off balance sheet items. See, claims against bank not acknowledged as debt. Okay, bank has not acknowledged as debt, but other party is saying that bank has to pay. There is a dispute. Now this is a contingent liability. Next example, liability for partly paid investment. Bank has invested in shares of other company, and the price of each share is 10 rupees. Bank has paid 5 rupees. Still 5 rupees is yet to be called by that company. So that becomes contingent liability. Liability for outstanding forward exchange and derivative contracts. This you have learned in your AFM, right? Till the time the derivative contract reaches its expiry date, you don't know how much will be received to you, or how much has to be paid by you. So that becomes a contingent liability. Next, guarantees given on behalf of constituents, acceptance, endorsement and other obligations, other items for which bank is contingently liable. Now, management representation regarding contingent liability. The auditor should obtain a management representation with respect to contingent liability. Now, in this management representation, what should be there? All off balance sheet items are properly accounted in the books of accounts. Okay, management should give a written representation that auditor, we have accounted all the off balance sheet items in the books of accounts. All off balance sheet items are supported by proper documents. Properly disclosed all contingent liabilities. Disclosed contingent liabilities do not include crystallized liabilities. Crystallized liability means the contingent liability turning into liability is known as crystallization. Okay, so you should not include those liabilities that have crystallized into contingent liabilities. Estimations of a financial effect is based on AS29. Include management's justification of not disclosing contingent liability whose possibility of outcome is remote. Next, audit procedures with respect to contingent liabilities. What audit procedure the auditor will follow? Ensure non-fund facilities given only to the regular constituents. Okay, non-fund facilities like guarantees has to be given only to the only to the regular customers, and only to those customers with whom bank is having long relationship. Okay, to the regular constituents. If not, inquire financial position of those customers. Adequate internal controls has to be there. Overseas supplier is paid based on shipping documents. Okay, you have to pay the overseas supplier on behalf of the importer only on the production of shipping documents by the overseas supplier. That means only after goods are sent you need to make the payment. Ascertain adequacy of accounting system. Test completeness of recorded obligation. Now, with respect to claims against bank not acknowledged as debt, this is one of the contingent liabilities. So, how you will verify this? Examine relevant evidence, review meeting of minutes, minutes of meeting, ascertain status of outstanding claims from management. Okay, you have to ask from the management the list of outstanding claims against the management with the management has not agreed or there is a dispute. Review subsequent events, provides evidence about valuation and completeness of those claims against the management. Next, guarantees given on behalf of constituents. This is also one of the contingent liability. Now, how you will verify? Adequate internal control over issuance of guarantees is there. Internal control over unused guarantee form should be there. Examine register to see whether expired guarantees or marked off. Generally, the guarantee will be given by the bank for certain period like 1 month, 2 months, or 3 months. So once that guarantee period expires, you should mark off that guarantee in your register. Next, ensure all guarantees are properly disclosed as off balance sheet items. Next, verify guarantees with letter of guarantee issued by bank and counter guarantee received from the customer. Verify securities held as margin if claim arose. Check whether provision as per AS 29 is required or not. Next, bills for collection. Ensure bills drawn on other branches of bank are not included. Verify outward bills with register maintained. Examine collection subsequent to balance sheet date. Examine procedure for crediting party. Examine controls exist to debit customers. No income to be accrued with respect to bills outstanding as on the balance sheet. Okay, this point we have already discussed earlier, right? But from the point of view of concurrent audit, this discussion is made. Next, audit report of bank shall contain whether balance sheet shows true and fair view. Now, the auditor, he will give audit report, right? So, in that audit report, what should be there? The format as prescribed under account under auditing standards, SS 700, that will be there. But this point should be specifically there. Okay, whether balance sheet shows true and fair view, profit and loss shows true balance, whether information and explanation asked by auditor is given. If you see all these points, you will cover even in the regular audit report format as per SS 700. Whether transactions of bank are within powers of the bank, this is an extra point. Returns received from branches are adequate, this point you will cover. However, in regular audit format also, audit report format also, any other matter which auditor considers to be brought to the notice of central government. Next, long form audit report. Now, what should be the procedure with respect to this long form audit report? Generally, in case of banks, there will be statutory central auditor and there will be statutory branch auditors. Now, this LFAR, it should be given by statutory branch auditor to the statutory central auditor. Now, the statutory central auditor at the entire bank level, he will consolidate this LFAR and he will prepare one LFAR for the entire bank. See, to be given by SBA and SCA. SBA means statutory branch auditor, SCA means statutory central auditor. SBA gives LFR to SCA and he consolidates at bank level. SCA submits LFR to management. Okay, the statutory central auditor, once he consolidates the long form audit report, he will submit it to management. Now, place LFR before ACB, audit committee board, with action taken or proposed. This management, it will place the LFR between audit committee board. Now, submit LFR to RBI within 60 days of submission by the auditors. Okay, finally, this LFR should be submitted to RBI within 60 days from the date auditor submits it to the management. Next, reports and certificates. In case of bank audit, the auditor has to give various reports and certificates. Some of the examples include report on internal financial controls of financial reporting, LFR long form audit report, report on SLR requirements. Okay, with respect to statutory liquidity ratio, auditor has to give whether the bank has maintained this SLR requirement of 18% or not. This SLR and CRR, they will be changing quite frequently, like for every 3 months or for every 6 months, the RBI will change them. Now, report on treasury operations, certificate on reconciliation of securities, asset liability management, certificate on interest subsidies and subventions. See, interest subsidy means generally for agricultural loans or for some education loan, the government will allow certain interest subsidy, right? So, with respect to that, a certificate has to be given. Next, certificate on corporate governance for listed banks, authentication of CRAR and other ratios reported in notes, report on Ghosh and Gilani committee. So, all these are some of the examples of certificates and reports that you will give. Still, there are various certificates that you will give to the bank based on the requirement of the bank. Next, scope of concurrent audit. What will be included in the scope of concurrent audit? See, the scope of concurrent audit is even wide when compared to statutory audit, because the statutory audit at most the statutory auditor will do audit for 3 days, but concurrent auditor, every day he will be in the bank itself. He will verify each and every transaction. So his scope includes cash, deposits, advances, investments, foreign exchange, housekeeping, other items. Okay. Now, foreign exchange. with respect to foreign exchange, what items you will verify? Check foreign bills negotiated under a letter of credit. Check FCNR, foreign currency non-resident accounts, to see debits and credits are permissible under the rules. Basically, there will be FEMA rules, Foreign Exchange Management Act, that should be complied. Next, proper accounting of inward and outward remittances. Inward means foreign exchange receipt, outward means foreign exchange payment. Ensure balances in no stock accounts are within limits. No stock accounts means the account that Indian banks maintain with foreign banks in foreign currency. Ensure verification reconciliation of nostro and vostro accounts transaction. Vostro accounts means foreign banks maintaining their account with Indian bank in Indian currency. Ensure adherence to guidelines issued by RBI or head office. Next, appointment of concurrent auditors. Now, whether concurrent auditor should be the staff of the bank or an external auditor, the decision is left to the bank itself. See, decision of own staff or external auditor is left to the discretion of the individual bank. Tenure will be decided by audit committee board of the bank, generally not more than 5 years. Okay, the tenure of the concurrent auditor will be for a period of maximum of 5 years. Now, do not continue with same branch for more than 3 years. A person should not act as a concurrent auditor of same branch for more than 3 years, and for same bank 5 years. Terms of appointment and remuneration will be fixed by ACB, Audit Committee Board. Now, there will be separate Audit Committee Board for each bank. Okay, just like there is a Audit Committee for the companies, there will be Audit Committee Board for the banks. Next, reporting. Report serious irregularities to controlling officer, head office. Okay, during the audit, if you find any serious irregularities, you have to immediately report it to head office or the controlling officer. Next, quarterly and annual zone-wise report to of findings to ACB. Okay, the concurrent auditor, he will report quarterly and annual zone-wise report findings to audit committee board. Next, report fraudulent transaction immediately to inspection and audit department, chief vigilance officer and branch manager. Okay, if any frauds are identified, you need to immediately report them to inspection and audit department, chief vigilance officer, branch manager. Okay, this is reporting in case of a bank. So by this we have completed revision of audit of bank. Before winding up the class, we have recently launched Lecturepedia app. In this Lecturepedia app, you can practice MCQs and you can also purchase classes of various faculties. You can download Lecturepedia app from Play Store. Okay, so yes, by this I'll be winding up this class as of now. We'll meet in the next class. Until then, take care. Bye bye. See you.